Okay, hi everyone. Thank you for joining us today. My name is Jia Shen from Syfe's advisory team, and I will be the moderator for today's session. Joining us today is our head of investment advisory, Ritesh, as well as Rui Ming Wei Choon, the co-founders of the Woke Salaryman. So through their very relatable comic illustrations to simplify financial concepts, the Woke Salaryman has been able to gain very strong online presence with Singaporeans who want to make better financial choices for themselves. And I also have to admit that, I always click into these articles whenever they appear on my newsfeed because the illustrations always manage to catch my attention. Right. So also, to our viewers out there, please feel free to raise any questions along the way via the Q&A box below. And we'll be taking some pauses during the presentation to address them. And so without further ado, let me now hand this over to the Woke Salaryman team, who will be sharing with us some tips to plan for their for our investment journey. So over to you guys.
Hey, thanks for the introduction, Jiaxun, and saying that you read our stuff.
Yeah, I do.
Hey, wait, someone IG story me to ask me share the webinar. I copy and paste first. Bishun, you help me buy time. Just
I help you buy time. Okay, so if you're wondering why Rumi and I have the same background, right? Actually, this is my background. Like, you see, the vacuum cleaner can move on. So what Rui Ming did was he made me disappear from the frame for a while and he stole my background. So don't be weirded out. We are not like bending time and space and we're in different spaces. This dude stole my background. Just to make that clear so nobody's confused. Why are they in the same thing? So if you see the plant, like my plant grew a little bit more because mine is the more latest updated version. Yeah. This dude stole my background, yeah.
And your lamp is on as well.
Okay,
yes.
Okay, thank you so much, Wei Choon,
for buying time. Yes.
Okay. Yes.
Got you enough time then.
Yes.
Let me share my screen. You see it?
Yeah.
Yes, we see it, Rui Ming.
Okay, today we're going to talk about why we still passively invest in 2021. Obviously, 2020 and 2021, they've been like crazy year for financial markets so far. And just want to disclaimer up front, we are not investing gurus, and this presentation kind of explains, our investment strategy and why it works for us and why it might work for you. I have to say this nowadays because nowadays the people, right, investing has become like a religion, so people become very offended whenever you say something that disagree with them. So I just want to put this out there. There are many paths to like wealth per se, and this is just our preferred path. Right, Wei Choon?
Yes, that's right, Rui Ming. Please continue.
Thank you. So nowadays, right, there's just like so much noise online. Last year, people have been boasting about like 80% returns, 100% returns, or even 200% returns. And I think it's just not helping because constantly we are like bombarded by all these ads, right? By entrepreneurs or like crypto traders or day traders, and they'll be like, oh, I'm going to teach you how to become a millionaire in 2 weeks, and this is how I did it. And you might kind of be wondering, right, whether like passive investors like ourselves or like the boring advice like our page has been putting out, whether is it still relevant today? Because I know, because we have always, right, very consistently, we have always told people to buy and hold a globally diversified portfolio across multiple asset classes. And this is like the most boring thing you ever hear. And we also know like it's damn boring one. Like we will never get like shit ton of views. Okay, maybe sometimes we do, but you get the idea. It's not clickbaity. And I think like this boring style works and it will still work. And today I'm here to explain why. Okay, anything to add, Wei Choon?
No.
Okay, thanks. You're very interactive today.
You're welcome, yeah.
Yeah. So the first reason, right? The first reason why we still stick with this is because you are still unlikely to lose money over the long term. So how I'd like you guys to think about holding a globally diversified, wow, this is damn long. Globally diversified passive index fund is because it kind of manages your risk. So if you look at the thing here, right? Financial success, so maybe you become like a millionaire or something. Financial ruin, you become bankrupt, you sell your house, and then you do things that people do when they sell a house. So where index investing sits, right? Oh shit, okay, it's actually here, right? is actually in this like range here, where you do not lose too much, but you also can gain like a significant you can also gain significant growth. And why I think this works for us, right? Because the first rule of investment, according to Warren Buffett, is is to not lose money, right? The second rule is remember rule 1. And by kind of like doing index investing, right, you won't exactly lose the market, because you're actually tracking the market. And because in the long term, most people actually feel a bit the market, right? So you actually will outperform them if you just hold and buy a long term. And of course, there'll be more people successful than you. I think the stats are like what, 4% of fund managers beat the S&P 500 over the long term, and that is fine. Maybe we just don't be in the top 4%. Maybe 5% is okay with us, and I think that's fair, because like the amount of work you have to get to get to the next, to get to the top 4%, yeah, I just don't think it's worth it from our perspective. So
Yeah, if I can jump in, like this diagram very interesting also, because we actually use the same diagram, like this exact one, right, to talk about the difference between starting a business or being self-employed and then also being part of a 9-to-5 job. So not to say 9-to-5 is boring. I mean, it could be boring. I think a lot of people say 9-to-5 is more boring than like starting a business. But the risk versus the potential extreme risk and the extreme like reward is so much more when you start a business. So there are many parallels also to this scenario. That's just one other way to think about it. Yeah.
Yeah, I think we always say something like, if you go join the civil service, that is like the index investing of
employment.
Jobs.
Yep.
Yeah, because you unless you, I don't know, touch kids or something, then you more or less
What?
No, I mean, if you don't like do too bad things, right? Like too
Yeah,
much,
you're okay, right?
you're okay one, you're
Yeah.
okay. Yeah, but of course you also never be, the public sector, private sector, super rich people. So just want to get it out there. So anyway, recently there was this like Berkshire Hathaway meeting. I'm not sure whether you watched, and Warren Buffett did this like very cool experiment. He was asking people which of the companies that are listed today, right, will be in the stock market in 30 years. And I think many people will say like usually like Google, Apple, right? Then what this lovable like grandpa did, right, is that he went to pull back like, what were the biggest companies actually 30 years ago, and actually was Exxon, GE, Merck. I'm not sure what Merck is, and IBM. But if you look at the if you look at the top stocks today, right, these are not even inside. I think we can send you the link after this webinar is over, so I'll send you that. So if you kind of think of it, right, like there is no guaranteed success to companies, because companies rise and fall. Even like Woke Salaryman, we have planned it for a scenario where it dies out in 5 years, because like
it'll probably die out, yeah.
It will die one day. Nothing is permanent. Not even like the biggest, most stable company you can think of. I mean, just 30 years ago, people thought like, is it 30 years ago? Maybe like 10 years ago, Yahoo was like a major player. And now Yahoo is not so much a major player. Even stuff like General Electric Motors over here, I think back in the 60s and 70s, it was put up as like the paragon of American ingenuity and innovation. But then, obviously over the past decade, it has kind of entered like a slow and long decline as well. So I think it just goes to show that no one is great forever. And the companies that you know and love today, they might not be around in 30 years. And let's look at some of the companies that we love and know today. Yes, they may not be around in 30 years. Even like Apple, Amazon, Google, right? But I guess it goes to show that, that the world can change in very, very dramatic ways. For example, look at Walmart and Amazon. I mean, last time Walmart was like the biggest thing ever. Amazon just came up in less than 20 years, overtook Walmart's position. So companies today will not be relevant in the future. And if you look at the average company lifespan on the S&P 500, right, which is the biggest collection of largest companies in the US stock market, the lifespan of companies have been decreasing. And I think it makes sense because nowadays there's just so much technological change, right? There's so much technology. And what happens technology is that it allows new and faster players to rise up. So if you are not at the cutting edge of innovation, right, it's very, very easy to fall out. Which anything that?
No, I agree so far. When I have more, I'll jump in.
When you
Thank
disagree, you tell me.
Okay, I'll jump in if I disagree.
Yeah. Okay, you must do that. Yes.
Hey, I wanted to just weigh in on this point actually. So I think this is a very good slide, and what you covered, again, you can make some good parallels to it as well. By investing in single stocks, you are taking, single stock exposure and risk. But when you're investing into the index, it has that natural ability to always contain the best companies. So there is a natural sort of survivalship bias there. And because of that, you will always get exposure to the largest, most successful companies. So when you do index investing, don't think there is, no science behind it. I mean, by virtue of investing into an index, you're always going to have exposure to the largest and the most successful companies. Versus if you're doing it by yourself and constructing your own portfolio by single stocks, you need to be like really ingrained into the market to figure out what to invest, when to churn, and stuff like that.
Hey, that's great, Ritesh. Hey, you should consider it doing more often since Wei Choon doesn't jump in very often. But it's all good. So anyway, back to what Ritesh was kind of hinting at, like in the long term, the market generally goes up, at least for US markets. I mean, there are some indexes who don't do as well. I can't say which one, but quite close to our home one.
Well, why cannot say it?
Okay, maybe like STI ETF. Because it made me say I hate you. Okay, it just doesn't have like the same power of America to attract great companies, and just doesn't have the skill, because Singapore is like a small nation, right? In a small nation, when you have a very successful product, you can't roll it out across like the whole nation. You roll it out like from Tuas to Pasir Ris, then that's it, okay? But in the US, they can do it like all the way from like Baltimore to Florida, and that's when like big growth comes in. So yes, US market generally keeps going up, although there is a risk of it not going up. I think there's always a risk, but I think the risk of that happening is generally lower than individual stocks failing. So you kind of measure like the risk and reward, which will most likely fail. Like, will America fail first, or will, let's say, Boeing fail first, or Google? Okay, maybe Google will stretch your imagination a bit, but I would still say, yeah, America, is generally quite a resilient nation. So this is not to say there are no risks to being a passive investor, and I know there will be someone in this crowd who will ask about like the Michael Berry, the passive investing,
the Ray Dalio.
Yeah, and I think we can get to that later. But anyway, the chance of being a passive investor, losing money versus an active investor over the long term is a lot lesser. Okay, next point. I think next point is something that we always like nag on also. So you might be bored listening to it, but I'm just gonna say it because we are just very boring people. This is just who we are. So if you're a passive investor, less time investing, more time focusing on your strengths, unless your strength is investing. So I think nowadays, I've seen all these ads, and I really dislike them because they kind of tell you like, hey, everyone can be a great investor, and I think what it sells, right, is the illusion that like if you invest, like every investor will make money, but in reality, no, not all investors will make money. And the investors who make money are, as you said earlier, reserved to like the top few percentile of the market. And I found that, right, like investing is a very technical set of skills, and it's really not for everyone. I think Wei Choon, you can kind of explain to them what you felt like when you look at annual reports and stuff like that.
Yeah, because like I'm very violently ingratiated into this world of personal finance. I'm an artist. I don't really look at this stuff, but I just have I just want to beat inflation. That's all I want to do. I have no desire to be a multi-millionaire. I'm okay. I just want to be able to grow my wealth so that I'm not eaten up by inflation. And when I look at, a lot of the people in the personal finance circles and how deeply they get into these things, it sometimes makes me very worried lah. Like, that's the reason I didn't say much beforehand, because I'm not an expert on these things. But when I see what it takes to be an expert, right, like aside from just the front superficial stuff you see of people, buying into profit, selling into profits, taking positions that are profitable, there's a lot of like stuff that involved in the ability to choose good stocks, to go and read company reports. I mean, like when I look at people like Warren Buffett, I admire his achievements. But you ask me to go and read company report, I rather not earn the money. I rather lose money. I don't want to spend my time reading company report. It just seems like another full-time job to me, and I don't want to do that. I want to make art. I want to create stuff, so I don't want to bother myself with that stuff. You ask me to go and round out my skills or become an expert investor, I rather lose money than do it. So that's just where I come from a layman perspective, lah. Yeah.
But hopefully Wei Choon doesn't lose money.
So far, after following your instructions, even though you asked me to buy a bit of STI ETF, I have on the whole not yet lost money. So thanks for getting me into passive investing, Rui Ming.
Okay, you're welcome. Thanks for giving me your background. Yeah. So I think what we need to realize that is, not everyone can be a great basketball player. Not everyone can be a great coder. Not everyone can be a great marketer. And not everyone can be a great investor. This dream that many people sell to others, right? Oh, you will 10x your income. You will get like 80% RI this year. Like, it just won't happen to like the most of us, And I always believe, like, sincerely, right, we all have our different strengths. So your way to earning money, right, would be to find out what your strengths are and focus in on them. And that strength might not necessarily be investing. So we see. So case study one, successful people, everyone knows Warren Buffett, everyone knows Ray Dalio. Well, he pointed the finger like the Lee Kuan Yew last time he did. Okay. So these are objectively rich and successful people, and they are very good at investing. Although I might add, and it's not written on this slide because I suddenly remembered, like, actually a lot of the money they made, right, was from running hedge funds. So they were also entrepreneurs in that way. So they earn money not just purely through investing, but for investing other people's money. Okay, so remember case one, successful people. Let's look at case two. So this is case study number two, okay? Also successful people. These are people who are also like objectively rich and successful. Will you say, let's say, Elon Musk is less successful than Warren Buffett? I mean, it's hard to say. After a certain point, money just isn't everything. Or would you say PewDiePie, is less successful than Warren Buffett? I don't know lah. Maybe some people say yes lah. And I think the answer is maybe complex if you go look at like pure wealth. But I would kind of point this out as to, there are many different paths to wealth. And these people, right, they don't necessarily spend all the time picking stocks, reading company reports. Do you think like Naomi Osaka goes to, read company reports in between, training for tennis? No, right?
So sekali she actually does. Then we look stupid.
Yeah, oh shit. Okay, Naomi Osaka, if you're watching this, I'm so sorry.
Sorry for assuming. Yeah, but I bet I'm likely to think they don't lah, right? Yes, I think the point here is also that just because you don't invest doesn't mean you are not successful or worth looking at. It's just like when we are too into these like personal finance circles, sometimes we are so insularly in this bubble that our heroes also change. And I also similarly, after having been in this circle for a while, have adopted some of like, Ray Dalio, Michael Burry, Warren Buffett as some of my heroes also, that sometimes I forget that, there are other things that people also look up to and are worth considering as metrics of success, not just how much you have gained in investing. Yeah.
Yes. Well, you were so eloquent, I can't remember.
I'm sorry. I was too eloquent too soon. Yeah, sorry.
Yes. Yeah, but anyway, there are many paths to riches, and I think many people think that see investing as like an easy way out, where actually you just have to be good at something and that way you can monetize it. Investors are good at investing, right? But these people are good at a whole bunch of other things. For example, like Forrest Lee, he set up SEA, one of like the fastest growing companies in Singapore, and you know, he's an entrepreneur, he's not an investor. Same with Tamil Lang up there as well. So too long didn't read, you know. Stop picking one way to get yourself rich. It's not the only way. You find out what works for you. If you like investing, then awesome lah, you know. Please go do your things. But you should never discount the fact that you are good at other things that can also make money. Okay, number 3 is another point that we stress about also quite often. If you're young, right, focus on earning power first. So let's look at this portfolio thing.
Hey, Rui, you're cutting out a bit. Can you say again from the introduction? Sorry, for this slide. Hello, Rui, are you there? It's not just me, right?
Oh no, I'm lagging.
Okay, you seem to be okay now. Yeah, you can do the slide again. Yeah.
I'm lagging.
You're all right now. Okay, maybe you're not.
Yeah. Can you hear me?
Yeah, I bet it's because you steal my background. Yeah, you can. Now can hear, but you're still lagging a bit. It's not just me, right, guys?
Yep.
Rui Ming, you there?
Hey, sorry. My internet provider is StarHub if you all want a reference.
Yo, don't insult StarHub. It could be your connection, your cable or not, you know, whatever.
I'm just saying, you know, it is StarHub. I'm not saying whatever. Okay,
reshare the slides again. Yeah.
Okay.
Yep, can see. Okay, you seem to be fine now. Yep.
StarHub is good. They have provided me with great internet.
They're great. Okay, yes.
Oh, yes. So anyway, if you have portfolio size, right, it matters a lot. So if you only have like 10K, right, as a fresh grad starting out, right, and you attempt to do like, you know, 30% per annum, you know, like if you invest that, 30% of 10,000 is only $3,000. However, if you pursue, you know, just an increment of $500 a month, you know, your annual addition to net worth, right, would be 6K, which will be double, right? So I think I don't want to go and say, you know, like investing is more important, obviously. But I think what I'm trying to say is that you should grow your capital before you go and try to take all this like, if you try to become like a very serious stock picker, even if you intend to do active investing in the long run. I think passive investing has a, whether or not you intend to do passive investing in the long term or short term, there is a place in your investment journey for it. In the case, some people say, you know, like 15 to 30% is quite low, right? Actually, Warren Buffett's long-term return is around 20% per annum. Last year was a freak show. I mean, let's not count last year's results, right? Last year, I think if you didn't grow your portfolio by at least 20%, you know, then that would not have been ideal lah. But because it was quite easy to make money last year. If you go and I was checking out this site, right, where they use this thing like called a random stock generator, and they randomize every stock, and actually they went to Google it. Most of the stocks make money. So in this thing called like a bull market, it's always easy to kind of like brag that you make like a shit ton of money. Yeah, but in the long term, something like 20% is quite reasonable. Ritesh, you look like you got something to say. Anything to add?
Yeah, so I think you actually covered it pretty well, right? Like, you know, in terms of, you know, short term, I think last year was just exceptional, right? And everything that anyone touched basically skyrocketed. But I think a lot of investors came into the market pretty much, you know, with the whole COVID situation and all, and they are like first-time investors, and they're now, I think, believing that whatever they touch turns to gold. I think a lot of investors haven't gone through the kind of you know, drawdowns that have happened in the past, and you know, now that they have entered into some of these investments, they need to be very, very careful going forward, because just I think a couple of months back, or last couple of months, suddenly some of these growth stocks have also corrected 30-40%. So I'm not so sure with a lot of investors, they like the whole, you know, move up, but when the markets crash, you know, if they're running out, that's where, you know, things get a little complicated. So I would always say that, make sure you invest according to your risk appetite. If you do want exposure to some single stocks, go ahead and take it, but don't make it like 100% of your portfolio. Build a solid foundation first, and then maybe explore these options as well, right? But I think the important thing is invest according to your goals, according to a time horizon, according to your risk appetite. And that would typically be a more diversified portfolio. And then on top of that, you can always add, these elements where, these can be multi-baggers, but even if you lose, it doesn't sort of derail you.
Hey, thanks, Ritesh. So I really like resonate with that as well. So what I do is that I have most of my money in in index funds. Then I use this as a foundation, right, to kind of like take wild risks on the stock market. So yes, or other investments. So yes, I do own like some Dogecoin. So just being a passive investor doesn't mean you are like damn boring and don't do anything exciting all the time. I mean, you can, but you set aside a foundation first. Then you can 1 to 5%. Then you go and play lah. See whether okay, if it becomes big, great. If it doesn't become big, okay, now I still have this like big foundation to kind of tide me through life. Versus you trying to put all your let's say you have $10,000, then you put it all in investments. The other you lose, maybe it dips like 80%, right? Then suddenly you only have 2,000 left, and then your life would dramatically change and put you in a position where you aren't able to kind of improve your overall earning ability, or your investment horizon, stuff like that.
Actually, I got a point to add also on this. So I remember when I was just starting my financial journey, when I first realized that, I need to start investing. Like everybody talking about investing, and then here I am just paying off my loans and not really getting anywhere. I don't really understand money. And you hear all these things about investing, and the idea that I had as a newbie was just investing was something I had to do, but I didn't understand the concept of like passive investing versus active investing. So I think one of the best pieces of advice that you gave me, Rui Ming, was that, because I think at the time my net worth was like 5K, because I was just trying to pay off my loan, and I was worrying about what to invest in. Do I buy this stock? Do I buy that stock? I think the best advice I ever got financially was when you told me to just wait until I have at least 6 months of my salary saved up first before I even start to think about actively picking stocks. Because it's like, I think the analogy you also gave me was like, it's like going to a high roller stable, or going to play mahjong, or going any form of like gambling or whatever, but your pot is so small. So even if you win like 50%, 70%, right, you come in with $1,000, that's not a lot of money. So what you should do when you are still young is to not worry so much about becoming a guru at active investing and picking stocks, because that is almost damn near a full-time job. I see, like the amount of research you have to do, the amount of like emotional and mental strength and fortitude you have to bear this kind of ups and downs. You might as well spend that time making money first. So that one sorted me out very, very well. Like. So it's not so much don't active invest, it's don't do it first until you are at a certain mark. So for anyone listening to this who's like me, a relative newbie, not so much interest in really becoming a guru investor, you can think about it like that until you have 6 months of your salary saved up, which for me it was around like 30 to 50K. Don't even start to think about active investment. Just get better at earning money and increase your income, which will Rui will talk a lot more about later. Yeah, that's all I have to add.
Yes. So I think according to this chart, right, that we did, I think the sweet spot, right, is around, if you really want to do active investing, and like no one is stopping you, because like, yeah, active investing is great if you don't lose money. I think like the sweet spot will be around like 500K based on a 20% annual return. So you get that first, then you can start to consider whether you want or you don't want. If you want to continue, then passive investing, then like there's nothing wrong. Some people do their business, some people become great, like I don't know, celebrities. They become they do a startup, and you don't really need to become a full-time investor, like, even though it's very fashionable right now. Like nobody wants to work anymore, right? Everybody just wants to day trade at home. Yeah, so I think that's
so you're saying until you have 500K net worth,
yeah,
you probably shouldn't even think about really becoming an active investor, at least with the most amount of your money.
I think that's how I will do it lah.
Oh, okay, got it.
Yeah, based on the 20% return. Yeah. So next thing I'll talk about is like compound interest. You all probably know about this, investing in stocks because of exponential, because of compound interest will give you exponential growth, right? But what I would like to share with you guys is that the same thing also applies for human beings, like people like you and me. Okay, so you can actually replace your investment capital with actually net worth over here. What do I mean by this? Okay, so the first 100K is always the hardest, and I know like it can be damn discouraging to listen to some internet people. Oh, 100K but 30, 100K but I know damn annoying. Okay, but just hear me out. Okay. So,
but we're not talking about by 30 here. We're just saying 100K wherever you are, right? The first 100K is hardest. That's your point, right?
Yeah, and I think the first 100K took me 3 years to reach, and I had to work like a dog lah. Basically, I had to work weekends. I had to constantly ask for promotion at work. I had to live on very little, and it took me 3 years to reach. The next 100K took me 2 years to reach. Why? Because like in part, my first 100K generated like significant returns. So instead of having to save another 100K, now I only need to save like 90K or something. And then all those connections I built before, all those freelance projects that I actually took on, they gave me a network to actually charge more and get more projects. So the next 100K took me 2 years. And then after that, it just kept growing. It took me 1 year, and now that's 6 months. And I think many people forget that. Many people, they have kind of given up on making more money for some reason, because maybe it's because you have like stagnated at your job, or maybe you feel like, I'm just not good enough for this promotion. But I'm telling you, I think the greatest investment, like really is yourself, especially at this stage. So right, if we look at how wealth is built, wealth is actually built by three things. You either earn more, you can invest in good returns, or you live below your means. It's very simple. I think if people understand these three things, our site can just shut down already. Just don't do anymore already, because that's just it. Okay, it's very simple stuff. Many people want to do both of this, and it's very hard. I think live below your means is quite a relatively easy thing to do if you're frugal and stuff. Then because it's less technical, than the other two. Most people want this too. In a perfect world, you earn a lot of money, and you also invest with like super good returns. But in reality, in my experience, I found out that you can only do one. Okay, I mean you can do two, then congrats, you take over a page or something. Yeah, my experience that you can only do one, and I've chosen like earn more for the reasons that I've stated earlier. So although I know this is not like a career development webinar, I think we should talk about ways of earning more income. Just very simple things like do a job that's valued more by the market. Negotiate higher salary, getting a higher paid job. Many people, I think many Singaporeans are quite like passive or shy creatures. Then we expect like the salary to be like handed to us, but I mean this is often not the case. Like you have to ask continuously and aggressively. Another way is to become like self-employed, start a business, start a side hustle, monetize your hobbies, and important thing is to invest efficiently, because while you're doing all these things, right, you might not have the time to monitor the market 100%. So once again, this is like nothing against like passive active investing. What you want to do in your free time is up to you, but I think we will advocate passive investing, at least for the beginning part of your journey up to you have like 500K. So I just want to stress, do the right thing at the right time. So when you start on your financial journey, right, like your earned income, can you see my hands here? Your earned income, right, will contribute to your net worth a lot more than investments. When you're 20 years in your financial journey, and actually this should be like drilled into everyone's head, because the chart of exponential curve is like compound interest is like that, right? The rapid rise only takes place, after 10-20 years, and that is when your investments will start to play a bigger role. So if you do want to focus on active investing, yeah, I mean do it when you've earned enough money. Okay, so exceptions. Exception is to previous slides unless your investments are. Oh my God, grammar error. I'm ashamed. Sorry, Wei Choon. I let us down.
It's okay.
Exception to previous slides unless your investments are related to your earned income. So many people, Warren Buffett, Ray Dalio, Cathy Wood, they manage some sort of fund and they earn fees of it. Great, congrats, like all power to them. Yeah, some people teach people how to invest, and then they get people to pay them fees for it, and these are investment gurus. And there's nothing wrong with that. That's how people make money. So what they've done is that they've found like a way to make money that has a lot of synergy with their main thing, right? And yeah, if you are not an investment guru, this might not work for you. Or last one, maybe you create content about stock picking. So maybe if Woke Salaryman was called the Woke Investor, yeah, then maybe we'll be more hardcore into stock investing, because stock investing and personal finance, even though they are related, they aren't exactly the same thing. Rachel, you want to say anything?
Yeah, sorry, my camera bugged out, so I'm just trying to fix that. But yeah, if we ever turn the page into the Woke Investor, I think I will stop writing content about it, because I really don't know and I don't care that much about active stock investing. And I think we have to say this also, if nobody gets it, that it's okay not to be a investing guru, because it's not easy. And I think this one, then I will just become an artist for the page. I will not write anything because I really don't know and don't quite care about it.
To be honest, even though I read up about like investment stuff, right, I do it just to help people answer their questions. So if I were to be like a freelance like copywriter or like a professional in the advertising industry where I'm from, I would just go back to doing that and just passively invest. I won't even read about all this stuff, because it is really that simple. But what is simple is not easy, right? Because and so actually the solution is simple. You can just buy this thing, just let it go, then just invest regularly. That's like the simplest thing to do. But it is not easy to do, because when you see people flexing, well, I have this, I have that, I made 100% gains, it is always difficult. But I think what I always tell myself is that it's not a race. Okay, sure, there'll be people who will be millionaires before me, and that's okay. I believe like by accumulating money in the Woke Salaryman way, in the stuff that we always like suggest lah. I think this will help you have like a long-term approach to help you build like a long-term approach to kind of maintain your wealth, because actual wealth is just half of the thing. The other half is actually how you actually manage your money, whether you can diversify, whether you can keep your wealth, whether or not you can have the spending habits to kind of make sure that money will be around 10-20 years down the line. Okay, and the last thing, right, is like some parting thoughts, because I know that people will kind of say this because it's something you get a lot, like not everyone can be good at their job or start a business, and be like you, come and talk about this, then be a passive investor. That's why I look at active investing as a way out, blah, 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 blah. So I just want to ask, can it, not everyone can be good at business, true or false? Okay, don't answer, because we didn't do the poll function. I'm so sorry about it. In retrospect, we'll do that next time. Yeah. Okay, the answer is absolutely true.
True.
Yeah, because, hey, thanks, Wei Choon. Not everyone can be good at their job or start a business. Absolutely true, But at the same time, not everyone can be good at stock investing. Do you see what I mean? To be successful, right, you have to be good at something. Like Naomi Osaka is good at tennis. That's why she became wealthy. She earned a lot of money, right? There's just no substitute for being extraordinary. So it's all about asking yourself, what are you good at? And with that, I realize we are 15 minutes overrun, and I'll just say stay woke, Salaryman.
Yay.
Yay.
All right,
Okay,
thanks,
I'm
Rui
not
Ming.
okay?
Thanks,
Yeah,
Wei
stop my
Choon.
share.
Yeah, can you hear me, right?
Yeah.
Okay,
Yep,
great.
yep.
I think we should take some questions for the Q&A because they are flooding in. So many viewers have actually, pointed out that when people talk about passive investing, it's always associated with S&P 500. Yes. So there was this viewer who actually asked, with the rise of China itself, does it actually still make sense for us to be looking at S&P 500, or whether or not, it is possible for one to actually include other ETFs as well?
Wow, actually, a lot of the literature that I have read online suggests that passive investing works better for the US market because China is such a new market. So you do not know whether the index system works there. You know what I mean? It could be that managed funds work better for markets like China or Hong Kong. It could be that way. It is possible. Personally, I still hang on my S&P 500 investment because US is the main driver of innovation and where a lot of big companies are. But what I do is like I buy a few China stocks just to participate in that growth. I do not own any China ETFs as of now.
Actually, I own China ETFs, but then recently it's like what you said, the thing with China and new markets. I mean, a lot of people also talk about the emergence of the Southeast Asian market and how much space there is for growth. But it's very uncertain because for example, my China ETF took a huge whacking because of the whole thing with Alibaba. So it's not even like I'm not willing to hold. I will hold. But the thing is, like, legislation is still coming in. There are some rules that are not even set. So there are many jolts and surprises that will come along for the ride when you invest, I think, in these emerging markets or new markets. That is just part of the thing. And when it comes down to being passive, it makes it a bit harder to be passive because there is less precedence for what will happen, and new things can always happen that will give you a jolt. Then you will be tested, can hold or not. And I almost also want to sell my position, but just hold. Yeah, that's just my experience.
Thanks, guys. So I think, just to add on to those points, in general, definitely people should have a more diversified portfolio, a globally diversified portfolio in general. What that means is, while US might still dominate your portfolio because, that's sort of the hub of innovation and growth and everything, and mostly US companies sort of lead the way in terms of, global presence, and they have multiple legs of growth embedded within them. But I think over time, what has also been observed is more and more economies are growing as well. And there are other pockets of growth that investors as a whole can capture too. And that's where I think an allocation to China, an allocation to, to a geography, which is, not just US, makes definite sense as part of your overall portfolio construction. Now, I think I agree with Rui Ming that, potentially if you're investing into emerging markets, which are not that efficient, there are ways to extract extra returns from those markets by being a little active. Now, having said that, it is not that easy as well. I mean, again, if you're doing it by yourself, by picking up individual stocks, the example was, I think Alibaba. Alibaba has done phenomenally well over the years, but, just a couple of months back, because of all these regulatory stuff, there was a setback. Now, again, no one is contesting whether Alibaba will be long-term successful or not, but do you want to manage that on your own by individual stock picking? That's the question to ask. Versus if you want to broadly participate in the China growth story, might as well just buy an ETF, hold it. If there are corrections, dollar cost average, and then, naturally you will, participate in that growth aspect from China and other emerging markets as well.
Right. So this leads me to the second part of the question, right? So we talk about diversifying into emerging markets as well as China. Is there such a thing as over-diversification?
Wow, what a complex question.
Anyone wants to take that first?
Yes, I guess there is such a thing as over-diversification. I mean, the thing that people always quote Warren Buffett, say diversification only works if you do not know what you're doing. And a lot of people take offense in that. But actually, I have a different view. I actually just see it as I'm a passive investor. Yeah, I don't monitor the markets full time. Yeah, fine. I don't really know what I'm doing in the Warren Buffett way. I mean, compared to Warren Buffett, obviously I don't know a lot, right? So yes, I think being overly diversified will limit your gains. However, if you follow like our philosophy in maximum earning power, I believe that earning power can overcome any. You can overcome any like how do you say it? It kind of evens out over the long run, you know, because you earn so much, you can buy into multiple assets, and at the end of the day, the assets all just not all, maybe they appreciate in value, but they don't necessarily lose money. So I go back to the first rule of Warren Buffett, like don't lose money, and I think over diversification is a lot better than over concentration.
But actually, I would also zoom out a bit more. I hate to be the academic kind of my point of view that does that, but also you have to take that in complex. Over diversification, over means that it's done to a point of detriment. But I also ask, like, what is the point of investing in the first place? So it also depends what you want to do. Like if you want like alpha returns, then yeah lah, there's obviously there's an easy point over diversification. You might want to go like heavy into one thing that you know and you know what to do with it. But if it comes down to just beating inflation, I don't think it is that much of a problem. To me, I'm not that bothered about that. It really depends on like the context of what you actually want to do. You know what I mean?
Right. I think like just to add on to that, in general, don't diversify for the sake of diversification, right? That's a very important point. Like generally, the more concentrated your portfolio, the more the potential return from it. Of course, the risk also increases manifold. So you do need to sort of balance that part out of risk versus return, and the diversification should be such that it helps you get return in a risk-adjusted manner, right? So you are trying to maximize your risk-adjusted return. Always try to think about it that way, and think what level of risk are you willing to take, and then think, how can I maximize my return based on this risk? The other aspect is, when I speak about diversification for the sake of diversification, right? Like, a lot of people have views on the market, right? Like if you go last 10 years, if you were invested into the emerging markets versus the US markets, you will actually, lose out on the outperformance of the US market, right? Like, US market has had a preeminence in terms of returns. So a lot of people come to us and say that, why are your portfolios, say 70% US or 80% US? And then, it is always hard to explain that, oh, emerging markets are supposed to grow more, so you should have more allocation there. But if you look at it from a return standpoint, it always doesn't add up. And US market tends to have that preeminence over the long term. Having said that, I think from a strategic standpoint and long-term standpoint, it is good to also identify pockets of growth and then strategically get allocations to those specific segments. And that's where I think, like, when you're thinking about China or some of these segments, there is actually material contribution from an economic value standpoint that these elements add to your portfolio. So I do think that those diversification do have benefits. So add diversification when it either reduces your risk or helps you hedge or helps you get a better risk-adjusted return.
Right. Okay. Thanks for that. Let's move on to the next question. So viewers always, associate a bubble when something, rise too quickly, when they are potentially overvalued, like what we saw, with regards to all like the meme stocks, right? So is there such a thing as like, bubble happening in passive investing?
Yeah, I'm so glad. Yeah, because I presented that slide because I knew it would come up. Hang on. Wait. All right, bonus slide.
I actually saw that in a slide, so that was leading into that.
Yeah, so like, yes, we are aware of the hypothetical, passive investing bubble. So the argument is that people buy the index funds, right, without caring about the underlying stock, which result in the index fund to be overinflated in price. Does that make sense? Wait, shouldn't you get it? Just to do a layman check.
Yes, I get it.
Yeah, so the argument is that people I just do passive investing. So I buy this, then in the end, the actual stocks in the S&P 500 don't matter as much. So that's the whole argument. I don't think this is a problem as of now, but it might be a problem in the future. Okay, so why? Because overwhelming proportion of funds are still actively managed. So I think the number that I looked back couple of weeks ago was, I think, 9%. Only 9% of investments are of funds are actively or passively managed in the stock market. So that 9%, so that in no way is a bubble compared to the other 91%, you know. And yes, it is possible as passive investing changes and becomes more popular, there is a risk that it becomes a problem. I think we shouldn't be naive enough to think that there's nothing wrong with passive investing. Like, it is not a magic bullet. Yeah, but I think the chance of this happening is still, for now, it's still lesser than the average investor outperforming market. I think in life there's never really a true set and forget. I mean, there is set and forget, but there's set and forget level 99, there's set and forget level 91. So there's never really a true, okay, hands off the whole thing. So to answer your question, for now, we're not too worried, but I've also preempted, you know, what we can do to kind of go against it. And yeah, it's actually a diversification across multiple asset classes. So as you can see, this blue part here is my holdings in the stock market. You know, I have some in real estate, you know, in case the stock market goes south. I even buy crypto. A lot of people think we're crypto adverse, but I do hold a significant number of crypto, you know, which is, you know, less than 5% of my portfolio, but I assure you it's a substantial amount. And
wow, so your portfolio very big lah. Is that what you're saying?
I mean, right now I make bigger again.
Whoa. No, I'm saying you only have less than 5% in crypto. Then you say, but it's a substantial amount. So you're saying your net worth very high, lah? Is it?
No, I'm trying to. Okay, now you're being a dick. I'm trying to tell people that being a passive investor doesn't necessarily mean you don't take risks.
Yeah, I'm just messing around. Yeah, please continue. I apologize.
You're asshole. Okay. So back to what we talked about earning power just now. I think working your earning power, your networks, your connections, and your ability to generate income, right, is still one of the more timeless things. So whether or not you are 40, 50, 60, if you stay relevant and you really enjoy your job, which is what we are enjoying right now, Rachel and I love our job. I think even if there was a passive investing bubble, in the worst case scenario, it wouldn't kill us lah. But of course, you know, that remains to be seen. The future is uncertain. Always adapt, yada yada yada. You know this stuff. We always nag about it. Okay, over to you, Ritesh.
I think you covered it really well, yeah. So nothing to add. I think well covered already.
All right. Okay. Next question, Jiaxin.
I think we'll take a pause on the Q&A because of time constraints. So Ritesh will go ahead with his presentation, the slides first, and then we can continue the last part of the Q&A.
Got it.
Yeah, Ritesh, over to you.
Sure. Just hang on a bit. Are you guys able to see this?
Yes.
All right, awesome. So thanks a lot, guys, for covering passive investing today for us. I think this is one of the linchpins for Syfe as a platform as well. We built our platform to sort of democratize investments for anyone and everyone. I think all the points that you covered previously have a lot of synergies in terms of the way our platform has been built as well. When we were thinking about Syfe, I think there were some things that were top on mind, right? Things like actively managed money tends to underperform over the long term, right? 90+% of active managers, they underperform the benchmark from a long-term standpoint. The fees that are charged for these active managed strategies are typically north of 1 to 2%. And what that means is essentially you are paying active management fee for returns which are, worse off than the benchmarks, right? Or the ETFs or the indices themselves. So why not invest into the index themselves, right? If you can easily invest into the index and in passive manner and reduce your cost, that might be a better solution overall, right? And then I think on top of that, what happened was over the course of the last, say, 5 or 10 years, there has just been too much information and there are just too many options available in the market. So even though you know how you need to invest to beat inflation and grow your wealth and all of these things, it is typically very hard to get started, right? You don't know where to start. Someone tells you open a brokerage account. Someone tells you, go buy this. But it is a little tough to start as a newbie when you have no idea, how to think about investment in a, much more structured manner, I think. So that's what I think as a platform, that's what we are trying to solve for. And if you look at our history, our company was started in 2017. So Syfe is a Singapore headquartered company. We are licensed by MAS. So that's a local regulatory body in Singapore. Our license is called the CMS license, which allows us to manage money on a discretionary basis for retail as well as accredited investors and institutional investors. If you look at the team, essentially the founder and CEO of Syfe is Dhruv Arora. So he comes with plenty of experience back from UBS and other, such organizations where, he actually saw the whole transition of money management moving from active to passive funds. So he used to be, doing ETF trading while he was at UBS. And that was, one of the, I think, precursors of him thinking about building this out for anyone and everyone, because a lot of people, I think, coming to us as, professionals in the financial industry, ask us, how do I invest? And we always tend to struggle in terms of giving them a proper answer because there are just too many options out there. The rest of the team, of course, again, covers the investment team, comes with a very, very high pedigree. So Nick joins us, previously worked at Timco and some of the other active funds. Richard is tons and tons of experience, 30 plus years of experience, having worked in the academic world as well as in the financial world. And Akiko is like our rocket scientist. So, she, heads up our, investment team in terms of managing the portfolios and all the quant strategies that go behind it. But not just that, I think we are backed by a very, very strong team. The whole idea of Syfe is to build portfolios in a cost-effective manner that can scale, laterally, as well as, we can democratize investment for anyone, whether you have a few $100 or a few $1 million, right? So it is very important for us to build on day one, our investment platform that can scale. And for that, we need a very strong technology and operations, system as well. And that's where, if you look at our team, I think these are the people who behind the scenes make everything happen per se. Quickly spending time a little bit on our operations and license. As I said earlier, we hold a retail fund management license. As part of this license, we are required to make sure that client money is kept separate from our own funds. And what that means is, even in a worst case scenario, something happens to Syfe as a company, we are required by law as part of the licensing structure that we would need to give back all your money in full, right? So the way it is ensured is all client money is kept segregated in trust accounts. So when you send money to us, it goes to a trust account with DBS. When we invest on your behalf, those assets are kept within banks such as Citibank and HSBC, right? So these are, fundamental things that are built in within the platform to ensure that assets that you invest through us are kept safeguarded. Now, quickly, I think it is important to also cover, what kind of options do we have on our platform. I think, as I covered earlier, what we want to do is make it very easy for someone to come to our platform and start investing. Typically, when it comes to money, there are 3 buckets that you can categorize your money into that, you want to make your money work harder for you, right? So what are the things that you typically want to do? You either want to save your money and earn as much interest on it as possible. So that's your savings bucket. Second is you have accumulated wealth and you want to generate some sort of an income on it. So that's your income bucket. And the third is you want to grow your wealth. So you have goals such as retirement, financial independence, children's education. All of these are long-term goals for which you want your capital to appreciate over time, right? So, fundamentally, if you can break it down into these 3 segments, then it becomes very easy to then align your investments to these long-term purposes or goals that you have in mind. And to that extent, if you look at our platform, we have a product or an offering for the savings bucket, which is called the Cash Plus portfolio, where right now, actually, the projected returns are at 1.5%. So it invests into high quality money market and short duration bond funds. It is not the same as a savings account. It does carry a very small amount of risk, but the return that you get is much better than what you're getting currently in the bank accounts, which is almost close to zero, right? So that's your savings bucket. So typically we say that part of your emergency funds can be parked here, and rather than getting no interest or very tiny interest, you get a projected return of around 1.5%. The second bucket, when it comes to income, we thought that instead of just focusing on income, we build a portfolio that has aspects of both income and growth. And that's where I think REITs as a product stood out for us. And REITs is also a very popular sort of asset class when it comes to Singaporeans and in this part of the world in general. Number one, because REITs generate a very high dividend yield of 4.5%. And the reason for that is essentially REITs are required by law to give out 90% of their income as dividends to shareholders. So, the dividend yield of 4.5% in the present context when interest rates are so low, I think is pretty attractive for people to be considering REITs from an income standpoint. But at the same time, I think REITs are also listed on the stock exchange, so their value do go up. And what that means is alongside the income, you can also look forward to some appreciation in terms of REIT prices. We can go into more details about REITs. I think if you guys have questions around the market outlook and the COVID impact and stuff like that, I think it will be a good discussion. I think you guys, Wei Choon, you guys, recently, I think, or just today, posted an article about property, right? So I think could be of good interest to cover that. But before that, I think quickly, the last bucket is your growth bucket, right? So typically, as I said, if you have long-term goals, depending on the time horizon, depending on your risk appetite, you can choose one of these portfolios. And typically, if you have a growth-oriented goal, you should be investing into an equity-based strategy because equity typically has that growth element embedded within it. So in our case, we have these pre-built, globally diversified portfolios. So you have the defensive, balanced growth, and then there is a high growth portfolio called Equity 100. And the difference between them is basically the amount of equity that you hold. So the defensive has 20% equity, balanced has 40% equity, growth has 70% equity, and Equity 100 is a 100% equity portfolio. So, and I think the reason for having these choices is basically to cater to, different kind of clients who have different risk appetite, different investment time horizons, and different goals that they want to achieve. And depending on these factors, you choose a particular portfolio, and these are naturally sort of diversified across asset classes, across sectors, across geography, right? So you don't need to do the heavy lifting. We do that heavy lifting for you. You choose portfolios according to, what your goals are, what you're, trying to solve for, and we will provide you the solution, right? So you just subscribe to these strategies and then, keep contributing regularly. Now, quickly, I think very easy to onboard on our platform. We can onboard clients using My Info. Even before you create your account, you can actually, see what these portfolios are, what are the underliers, what are the past returns. You can do some forecasting. So if you have goals, you can, think through how much do you need to contribute now? How much do you need to contribute on a monthly basis to achieve a certain goal in a certain time period, right? And once you invest, I think we pride ourselves to being very, very transparent. So everything is shown to you, whether it is, the values, the, returns, positive or negative, transactions, even the fees, everything is transparently shown. Now, in terms of fees, as I said, there is no minimum. You can start with any amount and try out the platform. So it's a very low risk proposition in terms of getting started. But of course, the more you invest, we have more scale built in our platform, and we are able to reduce your cost of investing as well. So, the blue tier is basically no minimum, 0.65%. As you move and have more investments with us, the fee progressively comes down, right? So 0.5% per year. If you are 20,000 or above, 100,000, your fee goes down to 0.4%. And on top of that, we are a digital platform. We are digital first, but at the same time, we understand that when it comes to investing, you just want to have some sort of, confidence before you go into those investments. So we have a team of dedicated wealth experts. So do get access to these, wealth experts. I head this team as well. So, the idea is for you to get started on the right foot. These are not commission-based, advisors. These are advisors whose job is to make sure to educate you and take the right decisions when it comes to investing. Also, I think this is the most important part. There are no hidden charges, right? Like, always when you invest with some, advisors or some platforms, they will always have, star marks where, oh, by the way, there is on top of the management fee, there are trading charges and, this cost and that cost. In our platform, there are no trading fee, there are no entry fee, exit fee. You can take your money out anytime, any point of time. So there is no lock-in. All the rebalancings, reoptimizations are done free of cost by us. So we bear those costs. Dividends are automatically reinvested. If you want to transfer from one portfolio to the other, you can do that freely as well. So free switching too. And generally the ETFs that we use to build our portfolios are, we weigh them in, and we have a very stringent process of, choosing these ETFs which have the lowest cost and the best representative for a particular, sort of exposure that you're trying to get. Now, again, I think this just, reiterates the point that why you should consider Syfe as part of your investment process. We are not, sort of active. We construct these portfolios from long-term goal-oriented, aspects. So, it is meant to be super simple, super easy to use. You can get started without having to worry about minimums or brokerage costs and other such things. And, very, very easy to get onboarded using my info, right? So versus DIY, there is a big learning curve. And even after that, whether you actually do good or not is very, very subjective, depending on your own ability to be, to be able to choose the right investment strategies, as well as, do you really want to have that implicit cost of, being in tune with the market, day in and day out, right? So, there is that cost of, can you spend that same time with your family or doing some other things? As I covered earlier, so we have a dedicated team of wealth experts. So do use us. On our website, there is a section on, the advisory team. So do click on that, and everyone who comes onto our platform does get a complimentary call to our experts. So do utilize it if needed. There are also some upcoming webinars. So the next one is, I guess, next week. So if you are very, very new to investing, I think this could be a very relevant, webinar for everyone. Also, there is, I think, a quick promo code. So thanks everyone for joining us today. If you want to sign up for Syfe, there is a 6-month fee waiver promo that we are giving exclusively for people joining in today. So do utilize it. I think I'll leave this here, and at this point of time, maybe we can take a few more questions. Joshua?
Yeah, thanks, Ritesh. Okay, so currently I have 2 questions for you. Okay, so the first question is actually with regards to concerns over inflation. So there has been a lot of talk about inflation recently. So this viewer is actually asking, how Syfe can actually help to hedge this inflation risk, whether or not there's any portfolios that they can actually consider.
Right, I guess a great question. So in general, when it comes to inflation, the portfolios that we build have aspects built in within the portfolio that caters to, these aspects of, insulating or hedging against inflation. For example, our core portfolios do have an allocation to gold, which acts as that inflation hedge per se, right? There are also certain sectors which can be looked at from an inflation hedge standpoint. Even REITs, for example, over the long term can be considered an inflation hedge, because real estate prices should ideally go up if inflation picks up, right? Like there should be inflation in real estate prices as well from that standpoint. So whether you're choosing our core portfolios or REITs portfolios, some of these portfolios have inbuilt aspects of inflation hedging built into them.
Okay, and then a second question to this would be that with regards to our equity 100, how does it actually differ from S&P 500? Is client actually better off buying that ETF directly instead?
Great question again. I think in general, as I said earlier as well, I think S&P 500 is a great index to invest into. But again, it is a US only index. Now, again, US does have a preeminence in terms of returns from a long-term standpoint. But if you are thinking about investing in a globally diversified manner and participate in the global growth, while US might be the, sort of, anchor in terms of driving most of your portfolio returns, I don't think you should just have a US-based portfolio. You should have allocation beyond US as well. And that's where I think a portfolio like Equity 100 fits into the picture, because you are adding some elements of China exposure, you are adding some elements of developed market exposure. And those aspects, I think, in addition to adding diversification, it actually helps you, as I said earlier as well, helps you generate a better risk-adjusted return. Let me see if I have a slide on this as well, but quickly I can show how our equity 100 portfolio performs vis-a-vis S&P 500 as well as a global portfolio, right? So typically, if you look at the MSCI World, our equity 100 portfolio is a more global portfolio in tune with an MSCI World kind of an allocation, because an MSCI World has some US allocation, but it also has allocation outside of US. So ideally, you should be comparing equity 100 against MSCI World. But even if you compare the equity 100 returns against S&P 500, over the long term, it results in a fair bit of outperformance. Now, again, we are not saying that we are outperforming because we are better managers or we are better actively picking up aspects of the portfolio which help us drive this outperformance. I can go into more details of how equity 100 is able to generate this extra return, but I think it might be a little too technical. But essentially, just think about this way: when you are investing into an index standalone, typically an index is created by having the highest market cap stock at the top and the lowest market cap stock at the bottom, right? So what that means is your returns will fairly be dominated by the performance of the top sector of your exposure. Versus if you go historically and do some research, and this is not research that we have done, like this has been decades and decades of research that has been done, where what has been found is like most of the active managers, when they claim to generate alpha, the alpha is not just manager capability to pick individual stocks. It is really some embedded factors which actually drive returns in a systematic manner to the equity markets. And that's where I think our equity 100 portfolio tries to capture some of these factors, where it whether it comes to growth stocks or value stocks, small cap versus large cap stocks. Some of these smart beta, as it is technically called, these factors, if you incorporate in your portfolio strategy, you can actually generate a little bit better risk-adjusted return compared to the index, and in a systematic manner. I think very, very important to mention, in a systematic manner, because if you are trying to take a view on the market, the view can always go wrong. But if you try to harvest, risk premia on a systematic basis, that has a more long-term sustainability. And that's what I think the equity 100 tries to do when it comes to the, extra return without really increasing the standard deviation or risk of your portfolio.
Sure. Thanks for that, Ritesh. And I think because of time constraint itself, we will just take in a couple more questions. And the next few questions, maybe the Woke Salaryman team can actually help us with that. There was this viewer who actually wanted to see a more Guailan version of you guys today. So with regards to the remaining 3 questions that I have prepared for you guys, maybe you all can use your Guailan method to address them. So the first question is actually with regards to your thought on investing in cryptocurrencies. So any advice for clients who are actually looking at investing in this asset class?
Yeah, I think crypto is wonderful, man. I mean, the returns are great. Just make sure you don't
not just Guailan for the sake of Guailan, do it, don't.
Wait, no. I mean, crypto is great if you're looking for like maximum returns, but you must be able to stomach like the absolute losses also lah. So one of the reasons why we said like earning power, right, is so that you can have this strong foundation and you can also buy crypto speculatively and buy in like significant amounts, maybe in amounts bigger than some of the most hardcore crypto enthusiasts. I mean, nowadays there are so many crypto people, they show their gains, then you ask their portfolio size, or the portfolio size only $10,000. Oh, congrats, So why not earn enough money so that you can go put that same amount of crypto and you don't, suffer any massive financial losses.
Yeah, I think the emotional impact is what I've seen a lot also. Like, the kind of stress it must be like to bear the ups and downs, especially recently. Like in your presentation, Rui Ming, you showed this thumbnail that had the Dogecoin millionaire. And I think a lot of people hail him as sort of a hero. I think he's a pretty cool guy also. Basically, he just put a lot of his net worth, or like basically most of his net worth, into Dogecoin, and he believes in it so much that even when Dogecoin was in the high that it was a few weeks ago, he refused to sell out because he believes in it so much. It reminds me a bit of the GME, the whole GameStop thing, when people say, I just like the stock. Well, what kind of rationale is that? Like if that is the kind of heroism and the kind of attitude that is looked up to, then I don't want to be a part of that. I'd rather just be boring and safe. And that's actually the way we run our business also at Woke Salaryman. Like we don't take any like what is it called, like angel funding or anything, even though we have some offers, because we just rather do it as a side hustle, wait for it to become profitable, then we take it on as a full 9 to 5. We're just boring like that. And I think it's just for in some way, like maybe because of the accessibility of investing nowadays with Robinhood and platforms like that, especially with teenagers getting onto it's sort of like, it's like we've forgotten how to be boring. And then in us saying boring things, sometimes people go, "Wow!" Like I wish more people say that. Oh, it's just a boring thing. Just be okay with being boring, and you lower your chances so much more. I think just be okay with being boring.
Right. Okay. Thanks for that. We move on to the next question because we know that you guys published a great article on like the REITs portfolio. So there was actually, this viewer who is actually asking whether or not how volatile is it in investing in REITs, whether or not it is still profitable during and post COVID-19 era.
Yeah, I think we gotta be honest here. Right? I think during COVID-19 is not great lah. I mean, if I might use the word, yeah, it's not that good. Yeah. Yeah. Okay.
What's that sound, dude?
The sound of me thinking of what to say. Can you not? Okay, now you're making it awkward. Yeah, I mean, okay, hospitality REITs were obviously hit very bad, but I think stuff like retail, healthcare, industrial, because of like the companies moving to Singapore during the pandemic, right? They actually did pretty well. But I think overall they still tank lah. I mean, and yeah, I mean, that's just how the way it is, during the past year. But I believe like in the long term, they still are a very good proposition for people to receive income. And I mean, they were well loved by Singaporean investors for generations because of that, because they are simple, they're reliable, and yeah, I believe in the long term, even though nowadays there's stuff like work from home, nowadays people like to buy stuff online, I believe that REITs are adaptable enough to change their business model to adapt to the situation. So I used to write a white paper for like an e-commerce company during my freelance days, and one of the big things was about property management. I talked about how companies are trying to merge the online and offline experience so that they can also augment that. That's why some shops nowadays they have like physical is going mortar, and mortar is going online. So you see all these like crossover episodes, and I think even during the pandemic, how painful it was to stay home. So to me, that kind of proves that there will always be a need for physical spaces, not just from retail, even when it comes to office. I think during this pandemic, I think some big companies moved to Singapore, right? Oh, I can't remember. I think like ByteDance moved to Singapore. I think Alibaba purchased AXA Tower, if I'm not wrong. Please correct me. I mean, okay, basically a lot of Chinese companies came to Singapore. More and more.
ByteDance for sure. I think that's something to note as well.
Yeah. Google's co-founder also set up like a family office here. He's moving stuff here. So I think the more rich people come to Singapore, the more there will be demand for property here. Because if not, where will you like work, live and play? No, I mean, this is not to say that people move their family office here doesn't necessarily mean they will live here. But I think living here, and also I think it's possible to not live here and still inflate the property price. Cause okay, so my girlfriend works in real estate, right? And sometimes she tells me of stories where people just buy the condos without even like looking twice. It's like buying sneakers, but I mean for them it's just buying a condo lah.
They see the virtual pictures and the condo tour, and they're okay with just buying it based on that.
Yeah, not bad. District, good district. Yeah, I think I can buy. So yes, in the short term, COVID has certainly affected the performance of REITs. But I think as long as Singapore remains like a valuable place for the wealthy to come here via being like a wealth hub, being tax friendly, tax efficient, providing good return on what rich people pay for their taxes. There's a difference compared to, let's say you go to Bahamas, then you don't pay taxes, but you also don't get any service from the government. But you come to Singapore government treats you like relatively well. They give you good return on taxes, and I think that's what rich people come here for. And as long as that continues, I think Singapore, when it comes to the property space and by extension REITs, I think yeah, it should do pretty well.
Also, I guess like, the fact is that there is a lot of misconception that REITs are just office and retail. As you covered earlier, now if you look at the REIT subsectors, there is, logistics, there is data centers, there is industrial, there is healthcare. So the retail and office, though, are a good portion of the REIT subsectors, they are not all that a REIT is. So when you're looking at these other subsectors, they are actually in a secular growth trend, right? Like, more online businesses basically means more need for logistics, more, online business also means, more data to be stored and all, right? So these are things that will remain in that secular growth trend. And on top of that, I think given that Singapore is a contained landmass and there is limited physical space available, with all the things that Rui Ming mentioned, there will always be a demand for real estate and property, and prime property more so, right? Like, you always want to be in the prime locations from that standpoint. And, to that extent, I think our REIT portfolio incorporates those elements. It contains all these REITs in a diversified manner, has all these elements, not just office and retail, but also, these data centers, logistics, and others as well.
Right. Okay. I think we have overran quite. Yeah. Go ahead, Rui Ming.
Jump in. Yeah. So just because REITs do well, right, doesn't mean all commercial property will do well. I think there's a difference. So I think we are past the days where property will indiscriminately like just to the moon. I mean,
even for Singapore, right?
Yeah, I think those days are over already. Nowadays, if you want to have like own good commercial property, you will need certain efforts. It's no longer like
fire and forget, confirm win,
Yeah, it's no longer stuff anymore. I mean, which is why it's another solid argument for REITs, because these properties are actually managed. So please don't, after watching this webinar, go out and buy like commercial property. I think that's too much of a pressure to put on us. So yes, just wanted to say that.
Sure, thanks for that. Okay, so because of the time constraint, as much as you want to actually take in more questions, but I think we need to go on to the very, very last question. And I guess, for this question, we can hear from three of you guys, and that would be the greatest investment lessons that actually help you guys to actually be where you are right now.
Maybe I start because I'm the noobest of all three. So I already mentioned it just now, the greatest lesson or the greatest thing that was told to me that helped me a lot was when Rui Ming told me to not worry so much about active investment until I even have money in the first place, because otherwise it's like going to a blackjack table and then like I act like I'm a big baller, but I only have $10. So even if I win really big, I win 100%, I end up at $20. So that's not that much. So it is to focus on the right thing at the right time, and to understand the place that investment has along the three pillars that we like to outline, which is to the three pillars of wealth, which is earning money, saving money, and investing money. So work on the other two first. That's my advice, especially if you're young and you don't quite understand all this investing stuff first. And as much as possible, invest in the market until it's time for you to you have enough. So what I think Rui Ming said just now was like what, 500K in net worth, and then that's kind of the place that he'll even start to think about, going active. Yeah,
I think mine will be like very boring, like it's similar to Wei Choon. I think when I first started my financial journey, I kind of like looked up to like a lot of investment gurus. I tried to become like a great active investor, but I think looking at the chart that I shared earlier, like your net worth versus like ROI, so I came out with this thing called like, I didn't come out with it, but I arrived to a conclusion that a lot of people also came to, which like return on time, because time is the most precious quality that an investor has, and how you make use of the time to earn money is really the most important thing. So I would say just remember your return on time, know your hourly rate, then you can determine whether investing is a good thing for you. Active investing is a good thing for you. Ritesh, over to you.
Thanks, guys. So I think, very, very simple for me as well. I think the biggest lesson is actually, learning about the power of compounding, right? So the biggest lesson for me is actually starting, much, much earlier in your investment journey. Like the more you delay it, the more time it will take for you to, compound your return and grow it per se. So if you have not invested, people ask me, what is the right time to invest? I mean, right time to invest was probably yesterday. But if you did not invest yesterday, probably the best next time to invest is today. So please go ahead and start investing now. Because if you delay another 5 years, that is, going to have a ramification in terms of how your wealth grows in the long term. So, please remember the power of compounding and start investing early.
I love how boring and unsexy we all are. But I think this is just in the short term. I think in the long term, right, boring will always be more sexy than other things because you are still in, right?
Agreed. Okay, thank you so much for the wise words, guys. And I think we have really come to the end of today's session. I really thank you guys, for joining us this evening. It was really our pleasure. To the rest of our viewers, we really look forward to your continued support and trust in Syfe. And have a very restful evening, everyone. Thanks, guys.
Thanks,
Bye.
everyone.
It was fun. Bye, guys.
Bye.
Bye. Thank you.